Good morning, everybody. Welcome to the Flow Show. Bit of a half day it's going to be for the Yanks at least. Markets over there going to be closing early, 1 p.m. Eastern Time US for stocks, 2 p.m. for bonds. But we'll no doubt be gone from the desks way before then anyway. Morning, Kay. How you doing?
Morning, Ryan. Morning, everybody. Yep, doing well. Cutting the week in half already again. Yeah, for the rest, everything okay. Smooth sailing.
Yeah, very much. I don't mind the US taking a holiday because it means we get to have an early day off as well, and
Yeah,
some putting the feet up also. So yeah, I'm not sure the Yanks do that when we have a holiday in the UK, but take it while they're there, I think. Definitely. Right, let's crack on. Over in China, we like to start in China. Well, I like to start in China anyway. PBOC foot further off the break. The FIX was up into the 713s from the 712s. Again, not a big one. Went from 712.91 to 713.12. So up a few pips on that, but still keeping things going. We did have a bit of data out, the Caixin PMIs, which came in a little softer. I thought this might have been a bit higher on the back of that data, but it wasn't. We just hit this bit of a traffic zone, 731, 732s in there, which I've been waiting for. I've been hanging on for a dip since I got out my longs. Bit of a panic move on those headlines last week. I haven't had a dip big enough to get back in, so I might have missed this train for now, but we shall see. It continues to go that way. What we've also seen in... Yes, mate?
some of us are still in. Not everything is lost.
Yeah, good. As long as someone's making money. Another bit of data, it's not usually on the calendar. I don't think it's on the calendar anyway, is we had this morning, we had some auto numbers from China, preliminary retail sales in the auto sector for June. They were down 8% year on year. So that sector still looking a bit stinky over there. You can see the Caixin Services PMI as well. Over in Japan, sources pieces saying that the government or the Ministry of Finance are going to launch new floating rate bonds. Now, this is to entice investors who might not be willing to get into bonds if they know that the BOJ is likely to hike and rates are going up. There's no point buying bonds at 1%. If 6 months' time they're going to be 1.5%, 2%. So they're going to be introducing some floating rate bonds, which obviously the interest rate moves as the interest rate from the BOJ moves. Now, they're only going to be doing this at the short end. They're looking at maybe 2 to 5 year bonds. So it is potentially a bit more of a... let's say a financial problem for the government, because obviously they'll be increasing their payments as rates go up, but they also need to sell their debt too as they wind down QE and the balance sheet. So it's a bit of an offset going on there. Is it likely to attract the big investors, or are they more likely to stick to the long end, K? And this is more for sort of your smaller, or I should say, not exactly retail investors, but that sort of ilk.
If they would do it right now, it would look like it could be a decent plan. But then there's this one line in the article says that the government will aim to issue the new note from fiscal 2026, and we are still 2024. So that doesn't testify of them giving a big helping hand to the bond market. And we also know that the Japanese whales are more looking at the longer end, although they may do short term now because they expect the longer end to yields to continue to rise. But that then is not really going to help anyone if they only start to do this in 2026, right? So of course it's going to cost the Japanese how shall I say, public money more, but why not do it now, and why wait until 2026? It's still so typically Japan. Everything is going so slow over there. It would have been it would have been, I think, a decent headline if they would have started with it straight away. But planning it from 2026, I don't think is going to change anything to the problematic right now. Imagine that Bank of Japan raises 15 BPs every quarter, or not even every quarter, but every half year for the next 2 years. So that's going to be adding another 60 to 75 or so BPs. The Japanese government will likely, if they continue with fixed bonds, not attract too much success with it. So yeah, it's an okay headline, but I fear it's going to come a bit late.
Yeah, well, that's actually might be the point, because if they're not doing it for another 2 years, rates, if they're on a rate hike cycle, it's likely to be near the end. So if anything, a variable rate will be locking in rates at the top, and then the only way potentially is down, which is better for the government. So I can sort of see it from a business perspective. You know, offer those when rates are higher, and there's more chance of rates coming down, and then pay less interest. But who knows where we are
Anything
in,
that
in
they
2 years' time.
went through that kind of thought process in Japan. I mean, yeah, we have to put everything in the perspective of we're in Japan, and that's the thing. Everything is going so slow there. If it is to entice the market to attract the market to continue to buy their bonds, you do it now, and then you give some incentive to the market
Yeah.
to do it. Now it's, if you look at it from your point of view, it looks like the government is taking the piss, really.
Yeah, that'll be a first. Government's taking the piss.
Anywhere
Well,
else, anywhere
yeah,
else,
I
Japan.
suppose so. Well, we shall see what comes of it anyway. Now, you may recall when we first started with Kishida and Abe and these wage hikes, well, pretty much 2 years ago now, when they first started hiking wages and stuff. One of the things I said we should look out for is how that impacts the economy, because obviously if you're raising wages, people getting paid more, the government's going to be raking in more tax. Well, the Finance Ministry just issued their tax income statement, shall we say, for fiscal year 2023-2024, and it stood at a record 72.1 trillion. Now, obviously, that's not just income tax, that's taxes in total. But that's going the right way for the government. This is this virtuous economic cycle. That's Kishida's key line there. That's his plan. This is it in play: raise wages, raise spending, raise taxes. It's trying to get the snowball rolling down the hill to a better economy. And for now, it seems to be going their way slowly, as we've been noted. Rengo, the big worker association, has come out with the final numbers for all those wage hikes. It's a bit rearview mirror stuff, but anyway. So the average for wages stood at 5.1% versus 3.58% last year, 2023, the highest in 33 years. So that was from the final survey. They cover a lot of firms and businesses. We don't know what the total national wage hike is. I don't think, or whether we get those numbers, I don't know, but that's for the largest union group anyway, the ones we've been watching. So again, good news, going the right way, and we'll have to see what happens next year. Right, PMI data again today, services sector front and centre this time. We've got Australia there coming in a little bit better than expected, though still confirming a drop from last month. Bit of bad news, though, for Japan, going further into contraction than expected. Quite a big drop from 53.8 to 49.4. So that's not looking too good over there, which is a bit of a shame, because their data had been coming in the right way, in part around the grounds. Retail sales in Australia looking fairly good, up 0.6%. There's some housing data, market data as well. They're building approvals up as well. So the data's starting to look a bit rosier in Australia, which will keep the Aussie dollar slightly underpinned as well. Coming over to Europe, and let's start with the central bankers first. There's only been a few of them, fortunately. ECB's Macklev says it's comfortable with, or he's comfortable with expectations for another rate cut. Says 2 cuts is probably going a little bit too far, but wouldn't rule it out. ECB's Simca says the last mile of inflation is going to be bumpy. ECB's Lagarde says we are very advanced in disinflation, and they are very attentive to inflation components and services, and that's important, as I'm going to show you in a moment, or tell you in a moment. We need to see profits absorbing wage increases, and says that also the spillovers of other central banks are taken into account. Now, we've had all the services numbers coming out from Europe. Spain giving back a pip over last month. Italy as well, giving back a little bit there in the services number. Final French number also a little bit worse than the flash and expected, but was higher over last month. Germany 2, a drop back from 53.5 expected to 53.1 from a prior 54.2. And then the pan-Eurozone number pretty much reflecting those as well. Now, the key thing that I took from these services numbers is that cost pressures are easing, and in some cases output pressures are easing as well. So that's Lagarde talking about services inflation. We hear it a lot from a lot of central banks that services is really the sticky element of inflation, and the service sector is the biggest sector for a lot of these countries. So this is all going right for the ECB, that they're getting a softening in these price pressures in services. So doesn't mean they're going to cut in July, but it just means they're still on the trajectory, and Lagarde's comments there very apt to that. UK services as well, a bit of a turnaround. We got 51.2 in the flash number, and it jumped up to 52.1. No, Simon, if you're listening, it wasn't a typo. That's the way it went. Still down on last month, but a fairly decent improvement over the flash number nevertheless, and still in positive territory. So all looking good there. Eurozone PPI coming in a little softer than expected as well. So again, that disinflationary process continues for that. Anything amongst that lot, Kay? Was there anything major from the Riksbank minutes or anything like that?
No, I think you said it. Like, price pressures are slowly abating. But for the rest, not wow. We know those numbers in Europe. Yeah, the France, for instance, is still below 50. But if you look at the rest, they are pretty okay-ish, right? And as you already said, Australia more or less printing half decent data of late. Actually, perhaps a bit better than what's shining through from New Zealand over the past couple of data points. So that is something that I noted. For the rest, not going to. No, I'm not going to take too much of a big lesson away from what's going on. By the way, did you see that the Swiss PMI? Because I haven't seen it. If it already came out, or was that a wrong reporting again?
Let me have a look. When was that due out?
Well, today as well, but I
yeah.
haven't seen it, and I've refreshed a couple of things, and I haven't seen it. Perhaps I missed it. If anyone else has seen it, perhaps give us a shout. But yeah, that's about it, man. I mean, the thing is we are likely going to see a bit of a similar picture in prices globally, right? Because it's been one big factor that we had across the pond, for instance, is that things can diverge, but usually run smalls the same way. So perhaps it's a little bit of a hint at the final data this afternoon as well. Of course, we've got the ISM. They can diverge, of course, but yeah, I mean, let's see what those US data bring, whether they will be divergent or not. Yeah.
Yep, we'll do, mate. I'm just looking at that. I can't see.
No, I can't see it either. I think it's
Oh, I've got it. This might be it. I don't
there
know.
we go.
There we go.
Patrick, 43.9.
That was the what was that one? That might be the manufacturing.
It came out on Monday.
There you go. Oh, yeah,
Oh.
it came out 1st of July. There you go. Services PMI rose from 48.8 to 52.
Okay.
There you go. So that was the manufacturing one that dropped back to 43.9.
Yeah, okay. Yeah, so the services, I haven't seen it. Okay, all right.
Yeah, there you go, mate. I'll chuck it in the chat room.
Not that it had too much of an impact on the Swiss franc. It's that number above 50.
Yeah, no, thank you very much. And yeah, thank you, Patrick, for that as well.
Patrick and Mark.
And Mark, look at that. Everyone's jumping on it. Good to see. Right, let's move it on then over to the other side of the pond. We had a little bit of data out yesterday. Canada manufacturing PMI was expected to pop up into expansion. That stayed unchanged at 49.3. We've got the JOLTS numbers, which once again shows you can't trust the data for more than 5 minutes. It's been trending lower, feeding into that jobs market softening moderately narrative, and then it pops up back above 8 million to 8.14 million. So just when you think things are turning, they go back the other way. JOLTS data it's a bit old hat. It's 2 months behind everything else, but it is looked at quite closely. We had Fed's PAL out and talking the book, shall we say. He says disinflation trend shows signs of resuming. We have made quite a bit of progress on inflation, but we need to be more confident before reducing rates. We're getting back on the disinflationary path. We need to see more data similar to what we've been seeing recently. The data does represent significant progress. And the unexpected weakening in the labour market would also cause a reaction. It says services inflation is usually stickier and tied to wages, so echoing what we were saying earlier with Lagarde and co. It says wage increases are moving back down towards more sustainable levels. Expects inflation may return to 2% late next year or the following year. He also says he's seeing effects of higher rates in the housing market again. So he's picking up what we've been talking about for the last couple of weeks or so. But he's given more hints that inflation's going the right way. But then that comment that inflation may return to 2% late next year or even the following year keeps the higher for longer message in play as well. So he's trying to guide market expectations without letting them go too far one way or the other. A bit more, you were watching this or listening to this live, Kate, a bit more clear and concise than the last FOMC.
Mm-hmm. And also there was this one line that he said that he wouldn't like unemployment to rise quickly. That's what I said in the comments. I think he's trying to create a little bit of well, an expectation is a big word, but guiding, as you say, the market very, very slowly towards. But he kind of comforted me in the thought that they are walking on a finer line or ridge, as I call it, than the dots have been showing, and the market has been forced to price. And he didn't change my view on that. I still think that it won't need a big downturn in the jobs market, for instance. He did name the housing market. So he's seeing those signs. So you got inflation on the one hand, which is sticky, maybe stickier for longer. I think he also has in the back of his mind that whoever becomes president at the end of the year, it's probably going to drive deficit higher. It could be an inflationary impulse as well. But then he did take the time to add the other part of the mandate in the jobs markets and did mention the housing market. So I do think that yeah, he gave a bit of more leeway to the leash, let's say, than the strict FOMC that we saw. By the way, I think we have FOMC minutes later today as well. So there could be a bit of small algo blip also. Is it today that we have the the FOMC minutes? But it comes towards the end of the market. So yeah, the US market for the best part, the equity market will be closed already by then. But I don't think we will see too much surprises there. But yeah, I mean, for me personally, I think he's massaging the way that if they would need to cut earlier, let's say September or so, that it would not come as a huge surprise.
Yeah, very much so. Do you think he's maybe making a bit of a rod for his own back by giving those comments? You know, if there's an unexpected weakening in the labour market, because obviously the market's going to guess what they mean by weakening. Is it going to be subtle misses? You know, unemployment rising to 4%. Well, he actually said that. He goes 4% unemployment isn't a disaster.
No, of course not.
But you know what the market's like. If it sees what it would class as a bad number, and it's going to start ramping up, you know, cutbacks and stuff like that. So I think that's the risk, and that's the potential opportunity for us in defining what a bad number is. A bad number also isn't 1 month. Okay, we've been here before, and the Fed have told us they don't take 1 month's data to heart with inflation. They're certainly not going to do the same with the jobs market. So yeah, mild misses are not going to get the Fed cutting any quicker. Let's put it that way.
No.
Only if we start trending in big spikes, if you like, or big negatives, will the Feds take real notice.
Yeah. Again, Ryan, I think we need to make a distinction between what is really bad and what is a slowdown. And yeah, if it's a very mild slowdown, they may not get the call to cut further, earlier. Sorry, but of course, if it's a big negative. But you know how the market is, right? I mean, it's sufficient that the unemployment rate ticks up to 4.1, that we get a number sub 100K, for instance, which is well below the average, and the ball will start rolling, because if you get like a mild miss, like as I say, 4.1%, for instance, instead of the 4 expected, which I think is still expected. Let me quickly scroll through. Yeah, still expected 4%. So you know how the market reacts, right? And it will take up the baton, saying like, oh, perhaps those dots are too tight. So yeah, it will be a mover if we get even a smaller miss, perhaps not for the longer term, and then we need to see what they say about it. We need to adjust the expectations again, and that compares, of course, to a very bad number, but we will have the time to talk about that perhaps then and fine-tune our comments for Friday. But a real bad number will have a completely different impact in markets as well. Get a very mild miss, your equity markets will probably like it, the bond market will like it. Get a very bad number, your equity markets might not like it. Huh?
Yeah, exactly. Yeah, good point. Got to look at the scale of things, of crappiness, if that's what we get. Right, so here's what's coming up later. We have got quite a busy data slate. We've got ADP coming up at 1:15. Have we got F.A.C.E today? We have got F.A.C.E today, haven't we? It's tomorrow. It's been cancelled, I think.
Yeah, today I think we have one.
Yeah, we've got F.A.C.E today, so we'll be covering that live on there. Then jobless claims 15 minutes after that. Then we get stuck into the PMIs again. We get the final S&P global PMIs, and then we get the big ISM services later on, and squeezed in between that is factory orders and durable revisions. So plenty to keep us ticking over. Probably after the ISM, liquidity and interest will drop off a cliff. So I know I've got a list of shopping the wife's given me, so I know where I'll be going, much to my distress, but there we go. We love and live, or live and love, whatever way around it is. Right, let's have a look at what's going on. I'm going to start over in oil markets at the moment, because they're continuing to... We've had this obviously the reaction to the storm happening in the US there and its potential effects. We've seen a little bit of easing off there. There was also, you also got the oil inventory data, which I think was quite a big drawdown overnight, which would have added to these moves. Was that right? Was it a drawdown in the?
Yeah.
API?
A big draw of 9 million barrels. Yeah. Very big.
Yeah, and we got we got the main EIA data out later as well, so that might take it away. Expected oil inventories to come down by 0.4 million. So let's see what that does. Again, the API can be a bit like the ADP to the NFP, but anyway. We know the levels we're looking at for oil around this 82.50 area, 82s, down to 80.5, $80. That's the main area of support, shall we say. It's been resistance and support long enough. So those are the key numbers. If this storm stuff passes by without too much problem, then we might see a bit of easing as we've already have. So keep an eye on that. Again, the loonie not really paying much attention to those moves. Dollar CAD remains stuck, though we're back below 137s again. Maybe having a look towards 136.50. I traded off that before. I'm out all of that longs. I've got a longs from a bit lower down in that move there, a little bit still on. I might have a little sniff again at 136.50. I'll see what's happening, what's driving it there. Obviously, with this big data, 28 pips away, I might just let it go and see if we get a move down to the bigger 136. But otherwise, happy to keep trying to play this range while it lasts for that one. Euro sterling, and don't forget, Ali. Yeah, we'll have a look at cable and Kiwi. Anything else? Chuck it in the comments for us to have a look at. Give us your view as well. Don't just say, look at this, look at that. Tell us what you're doing also and what your perspective is too. Yeah, Euro sterling, I'm still hanging on to this one. Election tomorrow in the UK, obviously. So that's going to be the big thing. We won't know what's happening until the early hours of Friday. So if you're not going to be up and about and you've got some pound exposure going into Friday morning, be careful because the results come out. The markets will be moving overnight, particularly towards the early hours. So from 11 o'clock, midnight, 1 o'clock, you'll get the first actual results because there's two, I think I mentioned this, there's two constituencies in the north of England, Newcastle and Sunderland, who traditionally have a race to report the results first because their counting office is like 400 yards down the road. It's like a foot race down there. And they were the ones who brought the first Brexit vote results that famous night. And it did cause one of the biggest moves. We saw cable coming off 500 pips, I think, on that first result. So 11, 12 o'clock is going to be when you see the first actual results and can be the main market mover. And then the rest will be dribbling in throughout the night. So again, if you're trading a quid through Thursday night into Friday, but you're not going to be at your desk or awake, make sure you have yourself covered either way. I don't think we're going to get any huge moves because the market pretty much banking on a Labour majority, but there still might be a bit of a knee jerk on some of those results, or if there's any shocks that we're not aware of. So just be careful for that. I'm staying short on this one. So I'm tapped a bit up the top here. I'm short a bit in the middle here. On average, I'm doing okay because I'm a bit more heavy on the top one than I am on the middle one, and we'll see what happens with that. But I'm looking for a bit of a pound reaction, bit of pound gaining once all is confirmed. That's if I'm still in the trade when it happens. Cable, Ali. Well, we've had another little look down at the low 126s, and it's held again. So this is becoming a really significant area of support. Call it 1020s down here, just ahead of the big figure. We're bouncing back up, tapping our head on the 127 level. So decent bit of range if you want to be picking the bones out of that between 126s, low 126s and 127s. Again, what happens with the US data today, I wouldn't be banking too much on that 127. If it's bad data, we're probably going to be through that fairly quickly, maybe moving up towards that 128 area. So again, might give a bit of a range to play as well, a bit of an extension on that one. Kiwi, you're looking at again, Ali. Yeah, I'm on my hands on this one. It's still, after we had this decent move up, it's still looking a bit weaker. You know, we're still getting these lower lows, lower highs as well. You're short at 60.80, which is pretty much right on the zone here. We're mooching around the middle of this area. Haven't held a decent amount of time below the bottom of this range. If we do that, then we're probably heading to the fib at least, 60.41, just above that fib. So that'd be a good bit of profit taking there. One other one in Aussie I am keeping an eye on, as I've been mentioning, this Aussie Kiwi, because I do fancy trying a bit of a top range go into this 110, 111 area. So I don't know where I'm going to start. I don't know if I want to start just before 110 or maybe start against these prior highs, 110.20s. I don't know. I might do just a few little pieces all the way up to the high 110s with a stop above that 61.8, the big figure. But I'm looking for a short there just to see if we play the range and hit the top. I know this Aussie data has been getting a bit better. I know the RBA have turned a little bit more hawkish, inflation being a bit more sticky. I can't see them hiking significantly if they choose to hike. So I think there's going to be a limit to how far the Aussie gains on this one. Kate, I'm going to bang it over to you, mate. Not much else going on. We're seeing dollar yen knocking up, but towards the 162s. It keeps going. It keeps going. It keeps going. I don't think we're going quite fast enough yet for the MO. It's going to be interesting to see what happens to this with the US shut, because that will definitely get the speculative nature being questioned on that if we continue to get moves when the US isn't at the desk. So that's something we'll have to keep an eye on. Intervention watch when the US is closed. They might want to get a bit more bang for their buck, you think?
Perhaps perhaps with the US closed and with the warnings that we had by Yellen, you know, in their treasury reports and stuff, they may not intervene if it's quiet. But I'm a bit worried for Friday. Imagine that we get a bumper report again, and the dollar shoots on Friday. Then we could start to break that 162.5, 163.5 market. But that's pure speculation. Thinks that the next line in the sand is 165. I don't think they have many lines in the sand, but they just look at where things get really painful. But has to be said that if you look at those yen crosses, it's a nightmare for them right now, right? Because everything is absolutely going up. It's not only the dollar yen, because the rest of the dollars have relatively stabilized, and but those yen crosses are absolutely still going and going and going. And I don't know, perhaps there is a bit of a danger come Friday, and especially if we would have, like the last time they intervened, that early Monday morning shoot, and then they intervene. So I'm really not countering it. I'm again thinking that should I buy a short-term put just for a week or so, buy a 159 just in case they they come in, that should be relatively cheap if you look at the options. So 1 week 159, I think we should be able to get that for around 10 pips or so. I could see myself do something if like kind of tomorrow or so, you know.
Yeah.
But it's just playing the interventions. If you don't play the interventions, what's the value of being long yen around here? And I'm asking this question every day, and I still don't see it, because stand in front of those crosses, the next morning you look at another 50 points higher in either one of them.
Yeah.
It's a painful one to, and of course it's a bit high to go and chase everything. Although it's still the trade that keeps on giving. Huh?
Yeah.
But yeah, so it's a tough one. I think the only thing here is to if you really think that there is a risk for interventions, is to perhaps buy a short-term put, and if for the people who have access to options, of course, because I'm really, I can't push myself to have much cash in it, or it must be like just an intraday, accompany the move, and that's it, you know. But not stand against it in any case.
Yeah, exactly. Options are the way forward. I don't know. I might have a little look myself, see how much they are. As you say, just a little bit of
But if
Friday through
mm,
Tuesday sort of coverage type thing. And
Yeah, if you know, if for those who have access in it, we know that usually an intervention is somewhere around 400-500 pips. 159 is nearly 300 away, so that should still give 100 to 200 pips if and you only pay 10 pips. I mean, paying 10 pips away is like it's a 1 minute move, you know, on a stop loss. And I'd rather do that than have a position. And even for the other side, imagine that you buy dollar yen here and tomorrow they intervene, then you go good luck. Yeah, and as Simon says, sometimes it pays to have guaranteed stop losses, because otherwise you may be looking at a big hole in your wallet as well. But for sure, it's going to cost more than 10 pips. And if you're short dollar yen or short yen crosses, the next 10 pips are just around the corner. So I still think it's unless you have guaranteed stops and already in a good position, it's better to look at options.
yeah, yeah. And just for those who may not know, don't deal with options, don't know what options are. It is just a low risk way. If you buy a put, that means you become short if it's enacted. You buy a put that's below markets. Okay, he's talking about buying a 159 put. That means it's a low price because it's called out the money because the market's way above. And if it costs him 10 pips, that's his maximum risk, 10 pips on a trade. And if we do get intervention and it's knocked down 400 pips, then obviously his premium, that 10 pips he's paid, is going to be worth more. Then he can choose to either play the option, take profit on it, or hedge around it by buying into the dip and locking in the profits. But it's just a low risk way. You don't have to sit in the spot price, CFD or whatever, and have the risk of it's shooting up 200 pips, or if you miss intervention, or shooting down 400 pips and it's costing you. Your risk is 10 pips. That's it. If it doesn't work, fine. You've lost 10 pips.
Yeah, exactly.
Losing 200 pips, being wrong in cash markets.
Absolutely.
So yeah, and if you're in the chat room, want to know a bit more about options, so you're always able to ask. We have to go. That it's not available for a lot of people, and for most retailers, it costs a bit as well. They're not priced friendly for retail traders, but they can still be worth just if you want to take a little directional trade without putting too much on the table. Right, over to you, mate.
Yeah, I'm not going to take too much time because we ran through a lot of currencies already. I mean, just one of the reasons why the euro is rebounding, it's not a big secret. The market has been looking at those divergences, those spreads in Euroland. The French-German spread has come down a bit. We can see euro is stabilizing on the back of it. Not going to spend too much time on this. I did have because that was a funky one, and I wonder where it's gone. I did have the Italian spreads as well somewhere on them, because they've got up in sympathy with the US's and with the French, and yet they've come off quite a bit. Anyway, oh, there we go. So even the Italian spreads were pulling higher on the back of Macron's call, and now they are coming back as well. So all of that is just a tad supportive right now for the euro, but we are stabilizing mid-range. We are not advancing much more in all those euro pairs right now. This is I think we've got bigger fish to fry with what's happening in the dollar now from now and into Friday. Got as Ryan was already saying, we've got a lot of data out today. In order of importance, of course, we will look at those jobless claims, but I think ADP today is going to be one little mover. We do have just before, in about an hour's time, in an hour and a half time, the challengers job cuts, and that's perhaps good one to keep an eye on the evolution of things. But then I reckon the main one for the afternoon. You've got the final S&P Global Composite and Services PMI, but the main one I think is going to be the ISM to keep an eye on. Especially look at the employment index, look at the prices index, of course, but take it in its globality of what's happening there, because we can have a few divergent numbers. So you may get a half decent number, but if it goes paired with a low employment versus higher prices, for instance, it may not look as good as the headline looks. So keep an eye on those ones. And I am going to, as I said, I'm very closely following this gold. I've got a bit, but I'm waiting for the data to confirm it. And as I said already a good few times, it has been holding better than what people may have expected, and then what even because that's the reason why I'm not like very heavy into it. I've got a little bit, but I'm not very heavy into it, and I still, and I'm going to repeat what I said, it's not going to take too much bad numbers here to get going. And we just tickling this short-term trend line. You see, it's been holding, then capped and capped and capped, and now we're trying to make a move above. If we get over the data, if we get a move through this 50-55 area, I think we may have a look at this late June spike high, at least in the 60s. And then I say, watch out. If over the course of the next days, this one here from early June gives way, I think the new impulse is really starting. It will already be confirmed around here, but I really think that if you look at the combination of all the data that will come out over the course of the next 3 sessions, no, well, not tomorrow, but they're on holiday, but watch out. And I really say watch out for the metals, because they are showing at least the intention to start again, to start going again. And silver, same thing. Look, we are at the top end of the channel. It's just coiling up. It's just coiling up. It could reverse, of course, if we get good data and higher US yields, especially. This could come off again, but we have also already seen that for silver, for instance, the data should not be too bad, because if the data are really bad, being an industrial metal, of course, this may underperform gold, for instance. Then gold will fly much faster. But this could do with like mildish data, not too good for the dollar, and then I think it could also push through. The metals are holding up better than what expectations may have been. That is still what I find of it. And then, yeah, coming back to that dollar yen, as you see, there's a bit of extension here, 162.5. Then on the really long term, there's something going on in the 163s. Now, I may wait not for all the data, but perhaps the data this afternoon, if they still show a little bit of positivity, wait for an extra push higher and then buy a bit of downside. But we're coming into that very, very long term, in that very, very long term. But I failed to see, it was from 1975-ish here, right? That you had that
Yeah, yeah,
really
that's the one.
long term, which is around
77.
164. Give and take 50 points. It's a it's a monthly chart because I think Ryan has it around 163 and a half. But that could indeed be a very, very big level coming up, and that's another 200 points from here. So yeah, as I said, still very, very tough because if you look at all those yen pairs, look at the euro yen, fresh highs, Aussie yen, fresh highs, Kiwi yen, fresh highs, you name it. And that's where the issue lies. And that's where perhaps they are not going to wait for another acceleration because just we are at extreme low levels in the yen pairs. But look at the price action. If you're in cash, it's still so hard to stand in front. I need to look at Swissy. Actually, just now, Swiss is strengthening just a tiny bit. But look at the main one, because this is the main trading partner, the closest geographical uh, uh, neighbor as well from Switzerland, the euro. And despite all the shenanigans that we had around like European elections, etc., it's still moving higher. So this is still one. This is one that I'm using for a bit of a medium-term view on what could happen to Swiss franc, and perhaps not even trading it, but just keeping an eye on it. Okay, as I said, today we just come back from levels, and I think people have spotted a bit of resistance coming up here in the 30s. So we ran up up to 30 yesterday, or very early doors, yeah, very early doors today, and now we're coming back a little bit. But this is one that I like to use as a barometer to do all the rest. And for as long as we are in this kind of grind higher for Euro Swiss to go up, I think the other pairs are also supported, such as Sterling Swiss, for instance. And I'm actually, but it's a real tiny one. I've re-entered just a very small one here. And stuff like we could add Kiwi Swiss to it. Although Kiwi is not looking that buoyant anymore, to me at least. I may switch. I may switch soon, into another pair. I still think Swiss is on its way back to a bit lower levels because of the rate cuts, etc. Are we ready for a bullish breakout in the Aussie on the? But we know what all the central banks are saying. I think really for what's coming now, it's a case of what the dollar is going to show us, Ali. It's all going to be dollars from here for the rest of the week, in my opinion. We know, but we know the RBA is a bit more hawkish. But look, I mean, we are struggling, right? We are struggling with those levels up in the high 66s. I still think we need to get above 67 figure 10 to feel very comfortable for it to go higher. If not, we can just hang around in the range, respect one or the other trend line somewhere. But I still think that for the more medium term, the danger zone is really 65.80. But in the meantime, we're tightening up the range. So this is something that just look at this range and trade what it is telling you. And I would say again, for the rest of the week, watch what the dollar is doing, guys, because this is going to be one. And then just one last word, if I may, Ryan, and I know, and I'm seeing the time here. We are trying. We're trying. This is not the first time that we're trying the cable, but we're trying. It's 127 again. I would still think that we need to break and hold above 127.20. We had this spike higher. and then came back straight away. We tried over 127, failed. We tried over 127, failed. We're trying again, okay? So this is one where you're going to have to combine the UK elections and the US data. I expect, and I don't know what you think about it, Ryan, but I expect sterling to be on the move in the next 48 hours and come Monday. I don't know what you think, but I expect sterling to move, really move, more than its 50 to 100 points.
Yeah, that's quite possible. Yeah, and it might, cable, if it dips, depending on your viewpoint, that might be a dip worth buying. We know where the support is down in those low 126s, but I'm still happy to do that in euro sterling. It's a bit slower, but if we get down to 84s, low 84s, I'll be happy with that over the election stuff. But we shall see. So yeah, I think. And then obviously we've got the French elections at the weekend, which still present a risk. If it's a hung parliament, you could see some flows out of France back into, and over into other countries and into the UK. Close proximity, economy ticking along. So yeah, markets like to go where there's a bit more certainty, particularly if there's political certainty. So yeah, there's all roads seemingly point to a better quid over the next few days. But
I kind of agree. I kind of agree with Gavin that the French elections are perhaps still a bigger risk than the UK. We haven't talked about it, but as we expected, there's a lot of left side candidates putting out just to give everybody a chance to fight against the right. But we'll talk about that on another show. And to reply to Ali, and then I'm giving it back to Ryan. Really, which side in sterling? Well, euro sterling is still looking a bit heavy. Cable is trying. This is the side that the market is telling you that they would be more likely to give a go. And so which I hope you won't, but put a gun to my head. I think if there is something really, the market is geared up towards a high one. And now it's over to the US data for confirmation or not. Back over to you, Ryan.
Thank you very much, mate. Just quickly, I'm going to tell you guys and girls again that anyone who takes a trader funding program in the month of July, I've just put the link there in the chat, will get a free 45-minute session with Blake. He can talk to you about anything or go over the TFP with you. That's for anyone who takes an account, even if you've had one before, I believe. Remember, taking a TFP account is a pretty low risk way of scaling up your trading funds if that's what you want to do. Your only risk is the evaluation fee. Okay, if you go and make $1 million and lose 2 million, you're not liable for any of those losses. So doesn't matter what you do, your maximum risk is always your evaluation fee. And there's been a few dodgy companies going pop. It's become a bit of a shark fest at the moment. Make sure you're with a company that you can trust, that does pay out, isn't going to disappear off the face of the earth the next day. But it's a bit of a wild moment at the moment, and the strong will survive and the weak will crumble.
And you will have access during your evaluation. At least you will have access to our chat room as well, which handy. So that means that we are putting our shoulders behind everything as well. So you're not alone in making your or taking your assessment or trying to succeed. There's loads of us in the chat room to help you with it, and not only us, even the people in the chat room are all very helpful.
Yeah, exactly. So stick with a name you can trust, which is us at ForexAnalytix. Anyway, on that note, have a great day, everybody. Thanks, Kate, as always, and we shall see you all tomorrow. Have a good one.